You're listening to Kitchen Table Finance. Join Dave Shotwell and Nick Nauta as they cut through the complexity of financial planning and serve bites of investment advice that are both personal and practical.
Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Good. Doing very well. Another podcast episode, and 'tis the season, right? Seasonal episode.
Season. Yes.
So a lot of people might think it is the Christmas season, but as investors for the past 20 or so years, it also means that we're going into Christmas, and there's some different opinions on the market during this time. You want to care to explain, Dave?
Well, yeah. So today we're going to talk about patterns and market patterns in particular, and like our pre-programmed human need to look for patterns, right? I mean, great examples are, everybody looks at the stars at night and looks for common shapes, right? Whether it's the Big Dipper or Orion the Hunter, or you're making up your own as you go, that's as old as human civilization and history.
Not to mention, we probably start in kindergarten, putting patterns together, isn't that?
Yeah. Oh yeah, for sure. So it's like part of our human nature to then look for patterns in the markets too, right? So here we are coming into Christmas. I guarantee you that in the next week or two, there'll be articles on the Wall Street Journal and Investors Business Daily and some others to the effect of, are we going to get a Santa Claus rally this year? As though it's like our reward for being good behavior, being good investors all year will be rewarded. Santa Claus will give us a little rally at the end of the year.
Yeah, so when I think of Santa Claus rally, I think of, hey, everybody's out blowing their money on Christmas shopping, but that's not exactly what we're talking about here, is it?
Yeah. Well, those two thoughts, it's funny because, we should say the Santa Claus rally is kind of a historical little bump that has been observed in the markets at the end of the year. And, of course, anybody who observes something like that then tries to explain it too. And one thought has been, hey, consumers are out spending their money, so that's good for companies, so it's good for the stock market, right? But this historical bump around Christmas isn't really our focus for today. It's just kind of what queued this up.
Sure.
And the Santa Claus rally is kind of it's one of those things where you can find a pattern if you look hard enough, and different analysts looking for that will like switch the dates on, is it before Christmas? Is it after Christmas? One year it's a little before, to the point where it's almost meaningless in a way.
Right.
So, bigger picture, there are and have been perceived patterns to the market. And our friends at Clearnomics wrote a really good piece on this just a little bit ago, looking at a little more pronounced rally effect in the stock market on seasonality called the January effect. And so the January effect, looking at the statistics from like 1929 to 1999, for large company stocks, the average return in the month of January was a positive 1.7% average over that period. And for small company stocks, it was 2.9%.
Wow.
So historically, that's a pretty big. January was the best month of the year, and that's a pretty sizable jump there. Okay. Now, from 1999 to the present, it's kind of reversed in that large companies now, the average return in January is actually a slight negative 0.3%. And for small companies, it's still positive, but it's tiny. It's like 0.1%.
Okay.
So we've seen this historical outperformance in January that then over the last 25 years or so has just kind of dissipated.
Gotcha.
So what's going on there? So has something about, so the first question is, that comes to my mind is, well, has something changed about January, right? And And, is there something about the markets or the economy that used to happen in January that doesn't happen now? And not really, right? There's nothing observable there.
Right.
And that's not really the point. And, you know, one other thing to keep in mind with these seasonal kind of patterns is that, you get a few years of something happening in a particular month, one way or the other, some random event skews the numbers. And looking at the flip side of it, October or September and October have historically been the worst months for the market, right?
Right.
But there's a few like really bad outliers that happened in October and September that really skew those numbers. 9/11 being one of them. The October
Sure.
1929 crash, the October 1989 crash, things like that happen in the 89 crash, the 29 crash didn't really have anything to do with it being October. It just happened that those two really, really bad negative effects both happened in the same month, right?
Right. Yeah.
So, is it just randomness and coincidence that's creating these skews one way or the other, or is it something real, right?
Right.
And then the other thing that helps these patterns, causes these patterns to dissipate over time, is the fancy word for it we use in the markets is arbitrage. And so it's the idea that once you observe a pattern like that, once market players observe something like that, they're going to try to take advantage of it, right?
Right.
And so what do you do as an investor? If you think the market's going to rally in January, what do you do?
Bye.
When do you buy?
December.
Right.
Late
Right.
December.
So if collectively everybody, if collectively enough market participants observe the January effect and decide to invest in December instead of January, what happens to stock prices in December?
They go up.
They go up. And what happens to stock prices in January?
They don't. Well, I guess it depends, right?
Yeah. Well, they don't enjoy that same bump, right? The people
Right.
that
You're right. Yes.
because a lot of that money's already in the market. And then now just hypothetically say we observe now that the January effect is now the December effect. What do you do the next year?
November.
Right. Right. And so that's the effect of arbitrage. And just keep in mind, stocks are supply and demand. So if you've got a pattern that is real and observable like that, chances are it's going to go away over time because people are going to try to take advantage of it, and the mere act of taking advantage of it mutes it.
Right. Well, and all these people that are writing about it are probably going to be taking advantage of it before they actually share it with people,
Right.
because otherwise they can't.
Right. 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 So our brains are seeking these patterns. These patterns may or may not exist. They may just be the effect of randomness and
Right.
certain events occurring at certain times. And then if they aren't, well, they're probably going to go away on their own anyway.
Right.
So to kind of build on that, Daniel Crosby, who we've talked about a lot over the last couple of months, but in his in the Behavioral Investor, he talks about there being a 3-part test for an idea like this being investable, and I thought it was pretty applicable to this seasonality idea. Yeah. And so the first test is it statistically relevant and observable? Okay, is there data? And
Right.
so when you look at the January effect from 29 to 1999, at least, yes, there was a pattern there. It was observable in the statistics, right?
Right.
The next test is it must be rational. There must be something that explains that. And so with the January effect, no one's ever come out and said, well, it's because X happens the first week of January and that causes, the market to rally. There's never been that rational explanation. And a good counterexample to this, you've heard about Bangladeshi butter production, right?
I'm not up on Bangladesh butter production.
So it is statistically observable and true that when Bangladeshi butter production goes up, so does the U.S. stock market.
Wow.
It's like this eerie thing, right? But if I said to you, "Hey, Nick, I'm starting a hedge fund
Right.
on the idea that we're going to invest money when the Bangladeshi butter production increases, because that'll mean that the U.S. stock market will go up," you'd think
Right.
I was off my rocker. I hope.
Absolutely.
Right. So while the idea there is, if you look hard enough and you look at enough data from enough different things, you're going to see correlations. You're
Right.
going to see one thing happening and another happening, but that doesn't mean there's any causality or connection between the two. It's just random. If you look, it's the million monkeys typing, theory,
Right.
right? If you
Yep.
look long enough at enough data, you're going to find something.
Yeah.
So
Well,
if
and
it
if
doesn't
you,
make any sense, if it's not rational, it's not an investable idea. So the
yeah.
third idea deals with the arbitrage idea. And so the third test is that there has to be something about it that makes it difficult for investors to do it.
Mhm.
Okay. So back to January, right? There's nothing, if you're an investor and you have money to invest and you want to invest, there's nothing that prevents you from looking at the January effect and putting your money in early, right? Trying to get ahead of it.
Mhm.
And there's no barrier to that. There's nothing that's going to make you say, "Oh, I don't want to do that in December. I need to wait to January," right?
Mhm. Right.
So there's no barrier, so it's going to get arbitraged away. The flip side of that, and Crosby's best example, and it fits for you and me because we lean our portfolios into value investing. Value stocks historically outperform growth stocks.
Mhm.
And so value stocks are stocks where the earnings of the company are relatively inexpensive compared to the rest of the market. So their share price is low compared to what their company earns.
Right.
How does that happen? Something about the company makes it unattractive to a lot of
Right.
people, right?
Yep.
So,
I
whether
always
it's
like to think of the Martha Stewart effect, right? Like
Mhm.
when she went to jail for insider trading, really didn't have anything to do with her company, but obviously the people
Yeah,
weren't too enthused on investing into Martha Stewart as she was going into prison
right.
for for insider trading. However, like if you look back, it probably was a good idea to be buying back then because
Yeah,
turns out she did a remarkable comeback and
yeah,
has really built a billion
yeah,
dollar business.
yeah, yeah. But it wasn't completely, like, you wouldn't have thought that somebody looking at that stock at that time, that was necessarily wrong, right? The company was kind of built
Right.
around her, and
Sure.
if she's not going to be there, it may not do well. So there's a
Right.
fear factor involved, right? There's a psychological barrier that
Right.
prevents you from wanting to take advantage of the fact that Martha Stewart's companies are earning X, the stock price has dropped to Y, and now it's inexpensive, but you're not sure you want to buy into that, right?
Right. Yeah.
Psychologically difficult. But we
Mm-hmm.
also know that the number one rule of investing is to buy low and sell high, right?
Right. Yep.
So those are the kind of opportunities that you should be looking for.
Right.
And so the idea that value stocks will likely could not be like, because of that barrier, it's not like everybody is going to be going, "Oh, well, value stocks outperform. I'm going to go put all my money in value stocks."
Right.
There's
Exactly.
still that barrier to psychologically taking advantage of that. For a
Yeah.
lot of people, they'd a lot rather buy Apple or Google or these
Right.
growth stocks that are expensive compared. Their earnings are low relative to their stock price.
Yeah. Well, it's the shiny, cool new thing on the shelf. A lot of times,
Yeah,
value stocks are the old, not so
yeah,
hip.
yeah, yeah. Right,
Like
right.
my grandpa owned that.
Yeah, right. They're either the Colgates and Procter and Gambles of the world, or they're that company that just um, had something happen. The CEO was caught in a scandal, or the CFO was embezzling, or something was happening, and it doesn't necessarily mean they're not going to keep making money. It just puts things in
Right.
doubt for a while. So
Right. Exactly.
yeah, yeah. So
So, Dave, as a, someone who's thinking about retiring in the next 1 to 2 years, how, if at all, should something like this impact them? Like, are there steps people should take, or how should they think about this in general?
Well, I think the bottom line is we shouldn't be necessarily looking for patterns like that. We should just invest and not worry about whether it's January, whether there's going to be a Santa Claus rally. Oh, the other one we didn't mention, it's an old cliche, is sell in May and go away.
Yeah. Yep.
Same, that's an old observed thing based on the same kind of seasonality that, from May through November, nobody makes any money in the stock market was the old idea. So, just ignore all that, because if it is, unless there's something about it that makes it psychologically difficult, that pattern's eventually going to be meaningless.
Right. Well, I
So,
think too, there's a lot more risk in, like, we've talked about this before,
mhm,
in terms of like trying to, even if you have the perfect pattern that's happened for the past 10 years that nobody else knows about,
right.
if it doesn't come to fruition and are not in the market and you miss, four of
Yeah.
the biggest days, that can wipe out,
Yeah.
a year or more's worth of potential returns. Where if you're in the market for the whole time, you're going to get those no matter what, right? You don't have to worry about whether you're right or wrong because you're in it
Right.
for the long haul.
Right. Well, and at the end of the day, this boils down to that idea that you should ignore, like, who cares if you don't make any money in May, June, or July? You may make money, you may not make money. It's the long-term averages that matter. So if you might get it wrong or you might get it right, who cares? That's a
Right.
perception,
Right.
that
Yeah.
to be in the market and be resilient, you just invest and don't worry about the seasonality, because you're not worried about 12 months, you're worried about the next 2 decades.
Right. And it's, boring and not fun and exciting. They won't write articles about it, but
Right.
10 years from now, you won't care either because you'll be in a much better place. So,
Right. 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 So,
nothing wrong with boring. I think that's the moral of the story.
oh yeah, yeah, I keep telling people that, but
Yeah.
they think I'm
Easier
talking
said
about
than done.
myself.
Yeah. There you go.
Now there's nothing wrong with being boring, Nick.
That's right. Absolutely. Well, this has been great, Dave. Appreciate it. If our listeners have any questions on this topic or any other topic, feel free to email us at info@srbadvisors.com. We would love to hear from you. Dave, until next time, my friend.
Thanks, Nick.
This is a Zedia Media production.